Now we're going to hear about how to think about risks in a particular asset class, namely mortgages, from Professor Nancy Wallace at the University of California. She's got a paper that's written on that, and you can access that. Professor Wallace, over to you.
Thank you very much, and thank you very much for having me on the program. Let me just get the screen share set up. So this is joint work with colleagues at Cal and also Carlos Vergara, who's at IESE in Barcelona. We've been working on elements of this paper for quite a while, and a number of contributions have been made that are buried in the works of the paper by scientists that I'm working with at the Lawrence Berkeley National Labs, both meteorologists, physicists, and engineers. So our goal here is to try to have an understanding of the implications of the fire incidence, prevalence, and severity in California on the mortgage markets. And so we're harnessing information that we have assembled as part of the lab that I run here at Cal on the mortgage markets, the bond markets, the derivatives markets that are tied to these markets. And very much in the spirit of the clarion call by the CFTC report that we're going to hear even more about today, I hope, from Bob Litterman and others, we have been working hard for the last 2 years of trying to connect this fixed income market to climate-related issues in this paper in California, but more generally across the country. So the story in terms of statistics is concerning. The increases in the fires and their severity has been very significant since 1972. You all read about this in the newspapers. In 2018. We had one of our worst death-related fires, but not by any means worse in terms of losses. In 2019, that was followed by 4 fires. One of the an important one of those was in Southern California, causing about $25 billion of exposure. And then last year, 2020, we had more than 9,000 fire events and 4.2 million acres burned. And of course, the death associated with this was also substantial. There are lots of ways of representing what the changes are. We could do graphs, we could do pictures. These are just 2 quick snapshots showing relatives in of 2018 relative to the 71-2000 averages. And basically you see, not terribly surprisingly, mean temperatures have risen quite substantially, especially in Southern California and the Central Valley. And the drought or semi-drought conditions continue. So the purpose of this study is to apply high-frequency geospatial data to estimate urban wildfire exposure of residential single-family homes and mortgages in California. And we're very focused on homes with mortgages because we know mortgages have to have fire casualty insurance. So we know that stock is insured and we know what the basis is and we know what the collateral values are because that's what we can bring through our lab. So we have very complete coverage of the market. In 2019, the California mortgages comprised about, this is just the securitized part of the market, Ginnie, Fannie, Freddie, and private label, represented about 17.5 of the entire securitized market in the United States. So the exposure in California is very substantial. The purpose of this study is an empirical investigation of the effects of large wildfire effects on the characteristics of the housing stock and treatment and control areas, so areas that burned and those that did not over the years, housing returns in treatment and control, gentrification and treatment control, and then mortgage default risk. And then the purpose, bottom line, is what the implications are for fire casualty insurance in the state, and then of course, mortgage pricing. So there are a lot of fires in our sample. Unfortunately, we have about 9,700 fires from 1970. This is data from CalFire. The focus of this paper, we're going to be looking at the large fires, so 40 or more acres. We're going to focus on the actuarial risk of urban fires, the actual modeling infrastructure that's going on to support pricing, and obviously indirectly the pricing of the mortgages and homes. For the mortgage markets, we're going to be asking something about default risk, but for the housing markets, we're asking something about the treatment effects of these fires on housing quality. And then obviously with the very large scale fires, of which we've had many, what the effects are on gentrification. So data, we've heard this for a number of people from the various panels, is a challenge here. And then combining the data is another challenge. So we've tried to get very accurate data on all of California for all of this market, for all of the mortgages. So all of our data are geoprocessed into 1.5 by 1.5 kilometer square grids and 4.5 by 4.5 meter grids for rural areas. So actually that should be kilometer grids. So the coverage is quite complete in terms of the geography. We also are using topographical data that is measured to the centroid of every lot for every house in our sample, and then indirectly mapped onto, or directly mapped onto the grids, where we compute the derivative from the topographical information to get the slopes for the centroid of every property. Slopes are going to be a very important feature of the risk of fires. We're using information on the wildland-urban interface. We've split it into two pieces, one looking at vegetative coverage and the other at urban coverage. And that again has something to do with the way we're modeling fire measurements, especially the meteorological measurements. Our meteorological data is from colleagues of mine at the labs who are working hard on these measurement models. We're using the very substantial database from the North American Regional Reanalysis Repository. We've applied two classes of model. One is just the weather forecast, weather research forecasting models, and then we're also using an urban coverage model because cities create their own weather, and the coverage changes the fluid dynamics of how the winds move and how these data are actually measured when they're projected on the earth. We then have verified these data using NOAA measurement stations so that they match what the measurement station data are. And what we have is we have daily averages that are averages from hourly data for wind direction, wind speed, maximum temperature, and relative humidity. So this is within our grids. And then we have data for the residential homes and their characteristics. And you may think that's an easy task, but we actually had to incentivize a vendor to give us an annual snapshot of the actual characteristics of homes. They had to remount their tapes back to the year 1997 so that we could actually see what these homes' square footage actually look like and numbers of rooms. A lot of the vendors overwrite their data, and so there's increasing disconnect between the prices you see and the characteristics of the properties that the prices theoretically purport to measure. And then, of course, we have the mortgage data, the contract structures, and their performance. So the first effort is to have an estimate for the likelihood of fire within these 1.5 by 1.5 grids. We've done this a variety of different ways using big data analytics, neural nets, and gradient boosted random forests. We actually find that the logistic regression models don't overfit the data as much as the more non-parametric models do. And so the results I'm going to show you and that are in the paper are logistic regressions. What's important here is this really accurate measurement at the grid level of what the meteorological information is. This is the best we can get working with scientists that are working on these problems. We have wind speed, maximum temperature, relative humidity, and then we have the slope measurements because the topography in the mountains in California has huge effects on the weather. We have the weather site, vegetation and urban coverage. And then very importantly, we have whether or not these winds were Diablo or Santana winds, which are these superheated winds that come from the east to the west. Most of our winds are from the sea eastward, but in the summer months with high pressure systems over the Pacific, we get a change in the direction of the winds. And so they come rushing down the western facing slopes at very high speeds. And we actually have measurements for when the winds turn and become a Diablo or Santana. And then of course the peak months. So what we find is the usual things. Everything works really well, and very importantly, the Santanas and Diablos are extremely important, as is the month of October. Most of these very serious fires happen in this very crucial month, where we get lots of these changes in the directions of the wind. Of course, wind does not cause fire. You have to have an ignition event, and the ignition events are largely related to things like infrastructure, our electricity grid, arcing of the grids, and then human error, and increasingly things like car accidents, the interface of the highway system and the grasslands, and Tesla batteries have been associated with a number of these fires. So this shows you the heat maps of June, very little going on. And then in October, which are the worst months, this is the Bay Area, San Francisco, and this is the Los Angeles, San Diego. And obviously there's very significant redness in these severe fire probability areas. One of the issues here is to compare the policy structure of the California Department of Insurance and their hazard maps. They were established in 2007, and they basically set the pricing structure for fire insurance in California. These are deterministic maps, and this is for Northern California. And as you can see, our maps are quite different from the established hazard maps that are the backbone of the pricing in California. And this is the similar picture comparison of the CDI hazard maps. And what we find is the real projection of fire in Southern California. Again, the maps show significant areas where the prediction is zero fire, and we find there's very few of those areas. When you compare, when you look at over these hazard mappings, very little in June. So, and then when you get into this most severe fire month in California in the recent probably 10 years, you can see that these hazard maps are, they're very flat, and the statistical differences between hazard 1 and hazard 2 are not statistically different, so they predict basically the same level. And many of our models, they actually are not monotonic. So there appears to be some problems here in the hazard maps that are the backbone of California pricing. So what are the regulatory distortions? Obviously, this is regulated at the state level. California actually prohibits the use of probabilistic models for pricing. What they do, they allow for these adjustments within the hazard zones for rate changes, but the insurers are concerned about the fact that these factor structures are too flat, as I just showed you, and that's a problem in terms of pricing or having accurate pricing. And then the last potential issue is that California prohibits the inclusion of reinsurance margins as an expense as part of the rate setting. So what we're going to do is we're going to take the map that I just showed you with all the red blobs. Each of those is an identifiable burn area by scientists at the CalFire, the California Department of Agriculture's division of CalFire, California Fires. And from that, we're going to create treatment groups. And this is the San Diego witch fire that happened in 2000. And all the little black dots, those are houses with mortgages. And so within the treatment group, we have more than 5,000 properties. These are properties that were designated by CalFire as part of the burn area. Some of them are partially burned, most of them are totally burned. We're treating them as all burned, but it's a reasonable assumption. And then we have areas outside the burn area where nothing burned. And then we have another area 1 to 2 miles outside of that where, again, nothing burned. So the CalFire burn area boundaries give us a framework for a quasi-experimental design. Basically, the treatment areas are these burn areas. They're random treatment areas because they're a function of weather. And actually the intersection of weather events with ignition events, you have to have both. And the ignition events in particular are many and varied, but are associated mostly with people and infrastructure. And then the fire boundary. And then we're going to test for the long run post-fire differentials between the treatment and control areas. Again, looking at the housing stock with this new data, house price dynamics, and then gentrification. And then lastly, we'll look at the effect on the mortgage market. So casualty insurance, in terms of what its effect should be on the mortgage market, is obviously very unclear a priori, because if you're insured, you would assume that as a homeowner or insured, you'd be indifferent for the effect of fire. Obviously, that's an open question. That's an empirical question. It is true that hazard insurance is complicated. Most people don't read their policies. I just gave this paper at Stanford. There was only one person in the room that had read their policy. What the coverage is usually tied to actually rebuilding your home. The only discretionary part of many of the policies, all of them basically earlier on and many of them now, is that the replacement of the personal property is fungible. In other words, you don't have to physically replace it to get the payout. So otherwise, everything is tied to rebuilding your home. And of course, you're replacing, and especially for some of these large fires, you're redeveloping a large swath of housing with new housing that are built to code. And that for many people, because the personal property is fungible, they throw that in terms of rebuilding the structure. So again, another data set. We now have these very detailed data on the performance of the mortgages, the actual characteristics of the housing, and then we've added to that new data on actual demographics of who lives inside these houses. And that change, we measure that on an annual basis. And so we're looking at the long run effects on house size, house prices, household wealth and income, and then what are the effect on mortgages. So if those things are mitigated, so we have positive effects on the former things, then perhaps the effects on the mortgages is less. So what we find is the long run house size effects are positive. So homes within the burn areas 5 years later are larger, about 1.4% larger than those in the controls. We find that the house prices after 5 years are about, these are returns, are about 4.2% higher than they are within the 1 and 2 mile rings. We find that the effects on household income are about 5% higher. So the areas within the households within the burn areas have higher incomes than the control at 1 and 2 rings. And they also have higher wealth, although the statistical significance here is much lower. When you look at foreclosures, we find that the within 6-month effect on delinquencies and foreclosures is quite small. It's about 60 basis points, both for foreclosures and defaults. And when you go longer out, it's even lower, but short-term in, it's actually quite small. Likely, we believe, because people believe that the externalities from all this redevelopment are substantial. And so it's better for you to rebuild a home and sell it if you want to leave the area, or rebuild the home or sell the lot and have it rebuilt by someone else. So figuring this out in terms of what are the monthly losses for the homes in these areas and mortgages, we find the October expected loss is about $9.6 billion, and for the mortgages on them, about $6.5 million. So just to wrap up, this is the first study that connects all these dots of this very large capital market, its exposure to the significant and changing risks in California, trying to use the best meteorological measurements and topographical, this intersection of the topography, the shape of the urban areas, and the movements of temperature. It establishes the actuarial risk of wildfire to the residential mortgage market, and then a very strong evidence for gentrification. Of course, that's only supported by the existence of the insurance companies and their willingness to support these large payouts. And what we find is that the effect on mortgage performance is quite mitigated by the insurance coverage and is only about 60 basis points. So implications for losses, bringing them to 2019. So the current stock of, or the end of 2019 is pretty similar for the end of 2020, is about $1.42 trillion. Given these estimates for October, the expected losses here are about 29.6 billion. The actual 2019 fire loss, this was just for 4 fires. One of them, a big one in Southern California with expensive real estate, was about 25.6. So it seems like our estimates are within the ballpark of what is actually happening. So we think this study has important implications for the pricing of California insurance, as well as for the needs for stress testing and understanding what this risk exposure is on bank balance sheets. And obviously, there's a lot of really great work going on right now in better probabilistic forecasting of fire in the science community. And I think linking this information with what's needed to understand fixed income exposure is really important. So I'll stop there. Thank you.
Thank you, Nancy. That was fantastic.